What's going on, everybody? Welcome to another episode of The Remote Real Estate Investor. My name is Michael Album, and today I'm joined by my co-host,
Emil Shore.
And we're going to be talking today about a hot topic that if you live not under a rock, you've probably heard about. People are talking about rising interest rates and a potential market crash. So let's get into it. All right, Emil, we're going to get talking here in just a minute, but curious to know, it's been a while, man. What's going on with you? Quick 30-second update.
In November, we moved to a new house and we had a new baby. So it's been a very boring month. It was a very boring month of November. Not very big, huge life updates. You know, for anyone listening, I do not recommend having a baby and moving in the same month. That was really hard and stressful. So,
or are you just getting it all out of the way all in one swoop?
Yes, but no, don't do it. Don't do it. So went to sleep anxious, woke up anxious. It's a lot of stuff. So space them out like 6 months or something at least.
All right. Well, for everyone listening, I've seen both Emil's new baby and house both in person, which was awesome. And they are both gorgeous. He does good work.
Thanks. My wife made the baby. So
yeah, it's team effort, total team effort. Yeah, on both fronts.
Yes, sir. How about you, man? What's new?
All kinds of things. The last week basically has been a financial gut punch. I had a bunch of issues with a sale that I did a while back. Put some money up in escrow, and some things went sideways with the city. So that's in trouble now. And I'm trying to also close on a new primary purchase in a day from now, 2 days from now. And I sent some money over from a financial institution, and they called me and says, "Oh, our servers crashed. We couldn't send that money." And that was delayed by about a week or so. And so this morning it just came in the nick of time. But I was like, how did you not think to tell me that the Amazon hosting servers crashed and you couldn't send my money? You're holding it hostage for a week. So it's just been a real whirlwind. And then my construction project has gone a little bit off the rails yet again. So dealing with that bank's issues as well. So it's been a lot. But as they say, when it rains, it pours. So hoping I'm through the worst of it.
Has anything in real estate gone smoothly for you in the last 6 months?
Yeah, actually. Well, I was going to say, yeah, because we bought that short-term rental and it's been awesome. But they also found out that it needs a new deck, which is going to be like $8,000 to $9,000, which wasn't found during the inspection. So no, I can say with a resounding no. It's been good, but not smooth.
I think there's a takeaway there is you should expect in real estate that things are not going to go smoothly. Like there's always little things. I think if you expect them, they don't feel so bad. And, I think you've been doing this long enough where it's just par for the course. Like that's how real estate works. It's a physical thing. It has things that break that need replacement. So I don't know, maybe there's a nugget of wisdom there for people.
Totally. I think the hard thing for me is that I'm my friend has this term, a hopeless optimist.
Yeah, you are.
And so I just hope things and expect things to go well. And when they don't, it's like, oh man. But then the other side of me is like coming from the insurance world. I'm a total pessimist. And so I have this like angel and devil on my shoulder, like, it'll be fine. Like, no, it's going to be terrible. So it gets exhausting.
Yeah.
But in any case, let's talk today about something that's been on everyone's mind. I think it's been all over the news. Rising interest rates and the potential for the housing market to cool off a little bit looking into 2022. So, Emil, I'm curious, you break out the crystal ball. What do you see happening here in the next 6, 8, 12 months?
I don't pay attention to too much news, but I think the Fed has basically said, yes, it's inflation. They've no longer used the term transitory. And so I think they've signaled that in 2022, they're going to move rates. How much higher? I don't know. I think it depends on, if they move it up a little bit, does inflation start to get in check or does it keep running wild? I think for sure in 2022, it goes up somewhat. I don't know how high it could be, but I think what's going to be really eye-opening, you and I were talking before we recorded, what percentage change in interest rates and what resulting change in price, like how does that change your monthly? So if you're a real estate investor on the sideline thinking, should I wait? Should I buy now? Like we're going to actually run you through the numbers of like, how does this change your payment and what does waiting potentially do? So yeah, might be surprised.
And curious, because there's been speculation out there talking that even if interest rates do rise a little bit, or potentially maybe even a lot, that the market won't really care because there's so much pent up demand. Do you see that do you expect there to be a pretty elastic correlation between interest rates changing and ultimate purchase price being reduced kind of in lockstep?
Yeah, it's funny. There's everyone's kind of expecting a crash. So you hear a lot of people saying they have money on the sidelines. So it's like, you and I were talking about this. When there's a lot of cash sitting there, how much can prices really fall? How much of a crash can there be? If there's usually a crash happens when no one's expecting it, and there's not a lot of money to kind of act as this safety net. But if things start falling, do a lot of investors come rushing in and prop it up? I think that's your question, right?
Yeah, so that's my question to a degree, but also maybe because people are chasing yield so much because things have gotten so much more competitive. When we see interest rates rise, we tend to see prices fall because people's purchasing power is diminished. But maybe people won't care as much this time. Maybe they're so hungry for yield and return that, while the interest rate may have gone up a little bit, diluting their purchasing power, they're like, I don't care. I'm still, what was a 6 cap is now a 5 3/4 or 5.5 cap. That's still acceptable to me.
No idea, man. I am no good at guessing. I mean, I think part of it is when you have such cheap money, it's like, why not take out a bunch of debt and go use it to get any yield you can? So I think if interest rates go up, I think it should check a little bit of that. But I don't know. I'm not smart enough, nor do I play a person smart enough on TV to tell you what's going to happen.
Yeah.
So I don't know. What do you think?
Oh, man, I was hoping you weren't going to ask me that. You were supposed to answer. That's why I asked the questions. I was like, if I can get it out first, he has to answer.
It's funny. I studied econ in college, but I have no answer for you.
Yeah. I mean, I'm of the opinion, and again, like you, I don't claim to be this genius person or even very smart person that has a real grasp on economics, global, macro, and micro. But I do think that there does seem to be so much money and people are overpaying for properties so regularly that even if the interest rate goes up a little bit, I don't know if prices are going to dip very much because they might just come back to offering full list price or slightly below list price, because instead of overpaying, they'll pay whatever the list price is. So I just think that there is so much money out there right now, both in the institutional world and people on the sidelines, that I have a similar thesis to you, that people are just going to rush in at the first sign of a downturn or a pullback or a crash, whatever you want to call it, and kind of prop up the market. So it'll be interesting to see.
As long as there's still a lot of rental demand and there's a supply shortage, right? There's high demand for single family. Rents are going up there. We've talked about it. So I think as long as there's that increasing demand and rents are going up and things are rosy, I think you're right. People are just going to keep piling in. So that kind of creates a price floor in my mind.
Yep. I'm right there with you. All right, well, let's talk about some numbers, because you and I were running this calculation right before we started recording. And I don't know about you, but I was pretty shocked to see these results.
Same.
And so what we did, for everyone listening, I guess everyone watching too, we did some calculations and we said, okay, we took a price point of $250,000 for a single family home. And this could be a rental, this could be a primary owner occupant, doesn't really matter, because all we changed was the purchase price and the interest rate. And what we said is, for $250,000, a 3% interest rate today is fairly reasonable. And we were recording this mid-December of 2021. So if you're listening to this in a different time and you're like, the interest rates are nowhere near that, that's my disclaimer, that's my disclosure, that when we recorded it, this is where they were at. Watch, we're going to listen to this in 2 years and be like, remember the good old days when you could get a 3% interest rate on a house?
I think we are going to be saying that.
I think they're so low. Like, this is historic lows. So $250,000 at 3% with a 20% down payment on a 30-year fixed mortgage. So that principal and interest payment on a monthly basis is $843. And the total amount paid over the life of that 30-year loan is $303,554. And so this is our benchmark. This is the number we use, 250K at 3%. So then we said, okay, what if there's a 10% pullback in price and interest rates jump 1%? So our new purchase price would be $225,000 at 4%. And so we came up with the same calculation, what our principal and interest payment would be, and then what the total amount paid over the life of that 30-year fixed loan would be. So the difference in principal and interest payment Drum roll, please. This number is $859, which represents a $16 a month difference. You're paying actually $16 a month more than if you bought the property for $250,000. And the total money paid over the life of that loan is $309,365, which represents a difference of $5,811 over the total life of that loan. And so if we are looking at just the property itself, it actually makes more financial sense to buy it at $250,000 at a lower interest rate, which like blew my mind. I was pretty surprised that there was that significant of a difference on a higher purchase price at a lower interest rate.
One caveat I just remembered, and we didn't talk about before we hit record, your property tax obviously is going to be a little bit, I guess it depends. It depends on where you buy.
On where you buy.
And how they assess it. Is it on sale price? Is it their own assessment? So that's one caveat, in case people are like yelling at us in the comments, oh, you forgot property tax. It's true. It's true. You'll have to figure that out because it depends on where you buy.
Right. That's multivariable calculus, ladies and gentlemen. We're not getting into that today. I mean, the other thing that you would want to consider too is your down payment if you're talking about an investment. So from a cash on cash return perspective, of on $250, you're putting down $50K. On a $225,000 property, you're putting down $45. So there's differences there too. But from a pure money paid over the life of the loan, monthly payment, there's definitely a difference, and it's actually more expensive on a lower purchase price, $225 at 4%.
Right.
So now we took that even further and said, okay, what if there's a 20% drop in the market? And so instead of $250, we're going to be getting that same property for $200,000, and we left our interest rate again at 4%. And so in this instance,
by the way, 20% drop in real estate. I know 2008 skewed our reality of real estate crashes. 20% is a pretty large crash in real estate prices.
It's pretty significant. Yep. So that monthly payment is $763, which is a difference of $80 cheaper than our base case of $250 at 3%. And then the total money paid over the life of the loan is like $275,000. So it represents like a $28,000 delta. And then last but not least, we said, okay, if there's going to be a 20% pullback in the market, maybe interest rates are going to move up more than 1%. So we did $200,000 purchase at 4.5%. The monthly payment on that is $810, which is a $33 a month cheaper difference than our base case. And our total money paid over life loans like $292,000. So it's slightly cheaper by like $13,000, $12,000 than our base case. So we saw a pretty massive reduction in purchase price, a 1.5% swing in interest rate, and we're only saving $33 a month in our payment and only like $12,000 over the life of the loan. So if you're someone sitting here thinking like, oh, I'm going to wait for that 20% pullback, it's going to be so impactful for me. On a monthly basis and looking at the life of the loan, it might not be as impactful as you might think. But again, Emil, to your point, property taxes is important to think about. All the other expenses might not be as impacted by purchase price. Insurance, maybe a little bit if we see a pullback in the market, if we see a bit of a recession, the cost to build might change a little bit. Mm-hmm. And so we could see some insurance premiums change a little bit.
Right.
But as far as all the other expenses, your repairs and maintenance, your CapEx, all these other things, your rental income potential likely won't change significantly. And so we want to look at the purchase price. Your debt service is really that variable here. Debt service and property taxes are probably your biggest variables when it comes to this sort of thing.
Right. And this probably explains why big institutions are land rushing to grab real estate, right? Like they've probably done all this math to say, okay, what happens
if
they
get this?
Right. You see, it's not huge. The other thing is we're saying a 20% drop from prices now, meaning it's a top right now, right? What if, you buy now, prices still go up 10% and then maybe it falls then maybe interest rates change and then it falls 10, 20%, right? So it's like you still have some padding there if you're not buying at the top. But anyway, doing simple math, trying to show people like the numbers, it could potentially not be a huge difference in your monthly payment, even with a 20% drop, which is huge.
Yep, absolutely. And something else, kind of to that point, when you're making offers on properties, I just went through this exercise and it wasn't an exercise. It was, an exercise with live fire, live ammunition is offering over ask. I had to go over ask on the new primary purchase that my wife and I are making here in the next couple of days. And I was like, the investor in me was like, oh God, no, like we can't do that. Like, that's just so, like, it totally irked me. And then I ran the numbers. I'm like, okay, the monthly payment difference is nominal. And the down payment difference, because I only have to come up with 20% of that, we put 20% down, is nominal. And so if you fall into that category and the returns still make sense, think about, you might have to be really competitive in your offers. And something that I always do is I try to imagine there is no list price, and I try to come up with it on my own. And then I'll like look at what it is. And it's this game I play. Like if I come up with a number that's higher than the list price, I'm like, oh, yeah, this is awesome. Like I can afford to pay more. And if I come up with a number that's less than, I'm like, okay, well, that's how my offer is going to be dictated, is based on the numbers.
So I was really surprised by these numbers, honestly.
I was too. I was expecting a much bigger difference between our base case 250 at 3% and then our most extreme at 200K at 4.5%. I mean, for all intents and purposes, $33 a month, eat out at Chipotle, 2 less times and don't get guacamole. And that's your payment differential right there. Well, thanks everyone so much for listening. That was our episode. I hope this was helpful, shed some light, some insight onto where the market might be going and how you might want to think about responding. As always, if you like the episode, feel free to leave us a rating or a review wherever you listen to your podcasts. They are super helpful for us. We look forward to seeing you on the next one. Happy investing.
Happy investing.